Welcome to The Explainer. Today, we're conquering what is easily the biggest, fastest, and honestly the most complex financial environment out there, the foreign exchange market. If you've ever looked at a crazy currency chart and wondered how on earth people actually make sense of it all, well, you are in exactly the right place. We are going to break down exactly how to apply 3 foundational steps so you can not just enter the market, but actually survive it and thrive over the long haul. To really wrap our heads around the scale of what we're talking about, just take a look at this number. Every single day, a staggering $9.6 trillion in trades is processed in the Forex market. Yeah, trillion with a T. That makes it the absolute largest financial market in the world, hands down. It operates nearly 24 hours a day, 5 days a week, spanning global time zones from Sydney all the way to New York. It is just a massive, fast-moving ocean of capital. But, okay, here is where we need a harsh dose of reality. If you contrast that unbelievable daily volume with the actual success rate of everyday traders, you hit a pretty shocking statistic. Data shows that between 74 and 89% of retail accounts trading contracts for difference, or CFDs, actually end up losing money. That's a massive failure rate, right? And trust me, it is rarely because of bad luck or some unfair market manipulation. Now, I'm absolutely not sharing that to scare you off. I'm sharing it to assure you that those failures usually stem from completely avoidable beginner mistakes. So to fix that, we've structured a really clear roadmap for today's explainer. First, we'll understand the basics. Second, we'll build a plan. Third, we'll master your mindset. And finally, we'll look at what it actually takes to survive the Forex market long term. The whole goal today is learning how to practically apply this specific 3-step framework. We're going to literally guide you safely from the pure mechanical nuts and bolts of placing a trade all the way through to those critical psychological battles you're going to face when your actual real money is on the line. All right, let's dive right into it. Step 1, understand the basics and master the mechanics. Before you even think about opening a live account, you really have to understand the fundamental forces of how money is made and lost here. And the absolute most critical concept to grasp right out of the gate is leverage. You see, leverage is what makes Forex accessible for most people. It lets you control a really large position with just a relatively small deposit in your account. But it is the ultimate double-edged sword. It's incredibly tempting for beginners to use crazy leverage ratios like 1 to 100 because, well, the math looks so appealing on paper for amplifying your wins. But here's the catch. When you are over-leveraged, a tiny, almost invisible fluctuation on a daily chart can just consume your margin and instantly wipe out your entire deposit. So how do we actually measure those tiny fluctuations? We use something called a pip. A pip stands for percentage in point, and it's basically the foundational unit of price movement in Forex. Most of the time, it represents the 4th decimal point in a quoted currency. Understanding the pip is totally essential because it's the exact metric used to calculate your profit or loss on every single trade you make. And when you're calculating those pips, you apply them to your position size, which is measured in lots. Now, a standard lot equals 100,000 units of the base currency. But don't worry, you don't have to trade a massive standard lot right away. To actually manage your risk effectively, you can apply a mini lot, which is 10,000 units, or even a micro lot, which is just 1,000 units. Let me tell you, sizing your lot correctly is literally your first line of defense against those leverage wipeouts we were just talking about. Wrapping up the basics, you've just got to remember that in Forex, you can profit in both directions. If you expect a currency to rise in value, you're feeling bullish and you take a long position, which just means you buy. But if you expect a currency to fall, you're bearish and you take a short position, meaning you sell. You're always trading one currency against another, basically just looking to capitalize on their shifting values against each other. Okay, that brings us straight to step 2, build a plan. We're going to look at strategy and risk management. Listen, jumping into a market that moves at the speed of light without a clear strategy is a massive, massive mistake. This perfectly illustrates how to apply a plan on a long euro to US dollar trade. Let's say you buy 100,000 euros at an exchange rate of 1.0500, right? If the euro strengthens and the price ticks up to 1.0525, boom, you earn a $250 profit. But if the market goes against you and drops to 1.0475, you lose $250. Without a hard plan, you might just sit there staring at the screen, hoping it goes back up while your losses just multiply. Now, what's really interesting here is looking at the complex web of global influencers that map out exactly why that price might suddenly drop in the first place. The Forex market isn't just lines on a chart. It's this living, breathing ecosystem of international forces. You might have a technically perfect setup, but sudden interventions from central banks, high-impact economic news like inflation reports or employment data, or even abrupt changes in trade laws can completely disrupt the market out of nowhere. A solid plan dictates exactly how you apply your rules to either sit out during major news events or adjust your position so you can handle that sudden volatility. So how do you actually apply a safety net against all that unpredictability? Well, you implement the ultimate solution to risk management, the 1 to 2% rule. This simply means you strictly limit your risk to just 1 to 2% of your total account balance on any single position, period. If you hit a string of losses, which, hey, happens to everyone, this rule ensures your account drawdown remains totally manageable and recovery is entirely possible. All right, let's move on to step 3, master your mindset and avoid those psychological pitfalls. You can have a totally flawless plan, but the gap between a demo account and live trading is huge. When real money is on the line, stress triggers these physiological responses that literally make us abandon our perfectly crafted strategies. The live market is just full of these psychological account destroyers. First up is FOMO, the fear of missing out. A currency spikes, you miss the initial entry, but you chase it anyway, resulting in a terrible price. Then there's revenge trading. You take a loss and impulsively jump right back in to quote-unquote win it back, which almost always leads to even deeper losses. There's anchoring bias, where you cling to old, irrelevant information. And perhaps the most dangerous trap of all, holding on to losing trades simply because closing them feels like admitting a really painful mistake. The crucial point to remember here is that losses are simply inevitable in FX trading. Rather than quitting, you have to examine your losses and rectify your mistakes. Literally, the best traders in the world take losses all the time, but they accept them quickly. They don't hold on to a sinking trade praying for a miraculous bounce back. They just take the small hit, protect their capital, and wait calmly for the next valid setup. Which brings us to our final section, surviving the Forex market and playing the long game. Successfully applying these 3 steps is exactly what transforms a gambler into a trader. We really have to highlight a sobering statistic, though. 80% of day traders quit within their first 2 years. Crazy, right? Why? Because they fall for marketing myths promising financial freedom in 30 days. They overleverage, they trade on pure emotion, and they just blow up their accounts. But that 20% who survive, they make it because they focus on applying a steady, methodical process rather than treating the market like a quick lottery ticket payout. So I want to leave you with a direct challenge to really think about. Do you have the emotional discipline to master this process before risking your hard-earned capital? Can you put in the time on a demo account, build a strict plan, control your excitement, and accept small losses gracefully? If you can apply these 3 steps with real patience, you have a genuine shot at navigating the incredible world of Forex. Thanks so much for joining me on this explainer, and keep learning out there.